Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
But look at some of the other alternatives. You can buy the at-the-money option, which is the 96 call, for about $2.85. So what's the risk there? $2.85. It's 38 cents in the money. Essentially, you're risking $285 per contract. How much could you lose? You buy a contract, you can lose $285 and any commission that your broker charges you. So there are lots of ways to trade it. But another way, as I was saying, if you thought that it was going to just stay in the range, maybe I would buy the 96 call for $2.85 and sell the 100 call for $1.03. Well, that debit call spread strategy would cost me $1.82. And how much could I make? Well, I could make $3.18. So that wouldn't be a bad risk reward, risking $1.82 to make, my art is just terrible here, but I could make $3.18. And how do I get that? Well, the difference between the two strikes is 5, less what I paid, $1.82. So if you had and that view would be more of a conservative, more of a neutral to a bullish forecast. If I thought it was getting back to 100 in the next 2 months, that would be one very, very conservative way to trade this, because you're taking advantage of that 100 call. You would sell that one, and you would buy the 90s. So I'm sorry, you know what? My math is wrong. That's a $4 vertical. So it's $1.82 to make $2.18. Sorry about that. 96 versus 100. Not a $5 vertical, but a $4 vertical. And so it's a little bit better than even money on your risk reward. And all you need is that the Canadian dollar, it's the U.S. dollar relative to the Japanese yen gets to 100, then you would more than double your money. Of course, that would happen at expiration. So those are a couple choices. Now, is the yen the only one? No. As Jack said, Canadian dollar. That may be a way that you could play this. If you think that the U.S. dollar is going to rally back a lot of what it lost in the last couple months, the symbol will be CDD, AUX. Another way. And even as Jack was saying, the euro, he feels, might be under some pressure in the next couple of months, symbols EUI. What would you buy in any of these? Well, if you were bullish on the U.S. dollar, you'd be buying calls. If you felt that the trend was going to continue, you would buy puts. If you're bullish on the dollar, you're buying calls. If you're bearish, you're buying puts. At this point, I want to take some questions. First of all, I want to thank everyone for attending. We had another nice crowd here today. You had very, very huge numbers. So that's a good sign that you're all coming. You're very, very interested in foreign currency trading, and specifically FX options. If you'd like to learn more about the product, you can go to the ISE website, www.fxoptions.com. I would love for you to go to Black Swan Capital's website, www.blackswantrading.com. Please sign up for their Currency Currents. It's free, so you can't beat that. Free global macro commentary. And once you start reading and enjoying it, which I'm pretty sure you will, then you may want to sign up for the paid service, Currency Strategist. That's, of course, up to you. And if you want to send Black Swan any emails, send it to info@blackswantrading.com. Let's see, Jack, let's see if we can take some questions. I had a question early on, Jack. Can anyone borrow, when you were talking about the 3 steps, can anyone borrow, number one? And number two is, who you're borrowing from, banks, brokers. And number two, then And how do you invest that money? If I wanted to do the spread, is it possible to borrow money cheaply here? I think you said it wasn't at 0.32, and then whatever, go to Australia and lend it out at 3.25. How can retail investors actually get involved in this, or is it just options and spot trading and futures?
The retail investor can get involved in this. He has to have a fairly sizable balance sheet to go ahead and borrow, possibly from a foreign bank or something domestically, borrow dollars and reinvest those proceeds wherever he chooses. If you would borrow dollars, invest in anything else, you'd be making the same thing. You'd be borrowing dollars to invest in your local real estate. You'd be doing this to invest in possibly a carry trade currency. When you're taking the dollar and you're putting it out into other asset markets, in effect, turning it into euros to buy a European stock portfolio, you're making kind of a carry trade there yourself. From a spot market standpoint, whenever you do a cross-rate trade, for example, say you bought the Brazilian real against the U.S. dollars, you bought that cross-rate, you're in effect, you're selling dollars and buying real to make that trade. That's a carry trade in and of itself that just sits there on the spot market. We don't have the ability to do cross-rates in the FX options, on ISE yet, but that may come. So there's all kinds of ways to do it, and of course, if your own balance sheet is big enough, banks will lend you money to use from a speculative standpoint, any way you choose.
Good point. And if you think back to the carry trade or the yen carry trade against the dollar, you could have used ISEFX options to sort of stop yourself out of that loss at some point. You could have bought put options to protect yourself on that play. So, that's a way you probably would want it to be an open-ended. I wouldn't want to do a spread because you need to have that protection. You're not going to want to do one versus another. You probably would want to protect yourself on that currency that you think could possibly really, really hurt you. So
no, you're exactly
Jack
right,
actually
Steve.
pointed that out, right? The one that you're assuming is not going to be volatile, but if it is, it can really hurt you, correct? Jack?
Yeah, and you can be as creative as you want. For example, say you own a big portfolio of emerging market stocks, and as I showed, if you take the Australian dollar and you compare it to the emerging market stock world, they're moving up almost point for point, very much in tandem. So if you wanted to hedge an emerging stock market portfolio, you would buy some calls, U.S. dollar Aussie calls on the ISE, to help hedge some of that if the emerging markets broke. So you can be as creative as you want if you understand the plays here.
Wow, yeah, that's a very good point, Jack. Very good point. Let's go through some of the other questions. Andrew had a point, and I think you actually mentioned this in one of your other presentations, but Andrew is very knowledgeable, and he comes to the ISE webinars very often. And he said, BRICS, it was sort of funny. He says, BRICS, yes, but he says actually it's really BICS because the Russian economy is broken except for oil. So he doesn't really include Russia as part of the BRICS. What do you think there, Jack?
Totally agree with him. Russia's a one-trick pony. If Russia doesn't have energy, it doesn't have anything. And that's why it's so funny watching Russia talk about potentially using their currency as a world reserve currency. Andrew's exactly right.
Okay. Question, let's see. Yes, I got the Andrew's question. EL wants to know if he can send his orders from his broker, and he mentions who it is. It's Options Express. Yes, of course you can. Remember, if you have an account with any broker that you can trade Google, Microsoft, or any other equity option, you can send your orders directly through that broker, and he mentions that it's Options Express, but it could be Interactive Brokers, could be Thinkorswim, it could be Trade King, it could be E-Trade. So any of those guys, in fact, there's so many more, TradeStation, Schwab, any of those guys, you could do that.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcast.